Hi everyone, this is BagRaider7 from Webull, and on this episode of Market Dial, we're going to be covering the top 3 tools that I use in my options trading. And if you watch this whole video, you will also have a basic understanding of options trading. So there are 2 basic types of options contracts that you could have. There are the bullish type, or calls, which are toward the upside, and then there are the inverse, which are puts, which are toward the downside, or bearish. The difference between an options contract and a long share position is that you cannot hold it forever. They have a finite amount of time that you could possess that contract. And if you don't exercise it or sell it for the premium, you'll be stuck with whatever the value of the contract is, whether it be worthless or in the money. So the term in the money refers to the profitability of your contract near the expiration date. A major advantage of options trading is that you could gain several times more than if you were to hold the regular long positions, or in other words, the underlying stock of that contract. Also, the risk management factor of it means that you only lose your premium if your contract expires worthless. Also, leveraging the different volatilities of it, whether it be down or up with a put or a call, you can use it to your advantage. Now we'll turn our attention to FIO. It was a major runner on Friday, and if you look at the leftmost column, you'll see the strike price. That's the amount that you agree to pay per share of the underlying stock versus what its current price is, whether it be up or down from that. That's known as strike. Then there's the delta, which is the amount that will change per dollar increase of the underlying stock. With the theta, it's going to slowly decay over time and actually lose off the premium, but as you move closer and closer to the expiration date, if you're what's called in the money, as we explained earlier, then you'll be able to execute this contract at your strike price. Now, at the expiration date, you're not actually required to buy the underlying stock. You have the right, but not the obligation to do so. As we mentioned earlier, there's different ways to move off the implied volatility of the underlying stock. Now this is forward, it usually doesn't move up or down much, it's pretty steady. But as you can see, this news article affects it very heavily because they need the lithium for their chips. So you can expect that it'll go up some percent, which multiplies several times for your contract. Gamma is a very important indicator of options trading. It's the amount that your delta or your change will occur per dollar increase. So as your gamma changes, so too does your delta. And if you have a very high gamma, you could actually use it to get a high delta dependent on the volatility of the underlying stock. By now, you should be very familiar with these 3 Greek indicators. Okay, that's all for today. If you found this video helpful, you could help us out a lot by hitting that like button. Also, subscribe for more content just like this.